Picture this: software programs that don't just follow instructions, but negotiate contracts, allocate resources, and even trade with each other at machine speed. We're not talking about science fiction. We are talking about the beginnings of AI agent economies, a new layer of digital markets forming right now. For investors, this is not a thought experiment. It's a question of where value will accrue, how risk propagates, and which companies control the trust rails. And if DeepMind's latest research is right, the shape of these agent economies will decide whether this turns into the next trillion-dollar platform, or a systemic risk that regulators scramble to contain. What is an AI agent economy? At its core, an AI agent is a piece of software that can perceive its environment, make decisions, and take actions autonomously. Unlike a traditional bot, an agent can plan across multiple steps, adapt to feedback, and interact with other agents or humans. When agents interact at scale, they start forming what researchers at DeepMind call a sandbox economy. They classify these economies along two axes. Origins. Do they emerge spontaneously, or are they intentionally designed? Permeability. Are they walled off from the human economy, or deeply interconnected with it? This framing matters. Other scholars add complementary perspectives. 10 principles of AI agent economics lay out rules for how these digital actors should make decisions and distribute resources fairly. So the question isn't if agents will form markets. It's what kind of markets they'll form, and how investable they'll be. The market stack. To understand where money will be made, follow the stack. Compute layer. Every agent inference consumes GPU cycles. Companies like NVIDIA and CoreWeave are effectively the landlords of this new economy. Multi-year capacity deals, such as CoreWeave's commitments on H100 and B200 chips, are the foundation. Model APIs. Foundation models are priced by tokens. Agent orchestration. Frameworks like AutoGen, LangChain, and standards like the Model Context Protocol, MCP, let agents chain tasks and interoperate across platforms. MCP is emerging as the HTTP for agents. Marketplaces and auctions. Experiments like Agent Exchange, AEX on the Harbor, a competitive multi-agent auction framework, shows how agents might bid for resources, coordinate prices, and clear markets without humans in the loop. Each layer represents a different investment thesis, from GPU leasing firms to agent marketplaces. Unit economics of an agent. Let's make this concrete. Take a typical agent task: 20,000 input tokens, 10,000 output tokens. Using GPT 4.1 Mini, the cost is roughly 5 cents per task. Using Claude Sonnet, it's closer to 21 cents. Add orchestration and data retrieval, and you get cost per task in the 0.05 to 0.30 range today. For investors, this is the unit of margin. If an enterprise is willing to pay $1 for an automated task that costs 0.20 to run, that's an 80% gross margin business. But costs depend on GPU availability, API pricing, and optimization of the orchestration stack. How agent markets, clear. Now, how do agent economies actually allocate resources? DeepMind suggests auction-based systems where each agent is given equal endowments to bid for scarce compute, data, or API calls. That avoids immediate inequality, but opens the question of how to enforce fairness at scale. Agent Exchange goes further, proposing a purpose-built exchange where agents list, bid, and clear services in real time. The Harbor platform tests how agents with different personas bid against each other, revealing strategic behaviors, including attempts at collusion. For investors, the lesson is clear. The first credible agent exchange operator could become the NASDAQ of digital labor. Revenue models. Where does revenue show up? 3 main categories. Usage-metered services, paper task agents for coding, customer support, or operations. Marketplaces. Take rates on agent-to-agent transactions. Mission economies, vertical swarms of agents dedicated to a societal goal, funded by governments, enterprises, or foundations. Each has different investor dynamics. Marketplaces scale fast if liquidity builds. Mission economies may be subsidized but durable. Usage-metered services depend heavily on API pricing power. Adoption signals. How do we know this is happening? Enterprise integration. GitHub recently announced support for multiple coding agents from OpenAI, Anthropic, and Microsoft inside the IDE. That's mainstream distribution. Standardization. The Model Context Protocol is gaining adoption across ecosystems, making agents interoperable by default. Capacity build-out. NVIDIA CoreWeave multi-year GPU deals signal that supply chains are being locked in for agent inference at scale. These are the adoption curves investors should watch: distribution, standardization, and infrastructure lockup. Risks and challenges. Of course, every economy comes with risks. Systemic spillovers. A permeable agent economy could crash markets faster than any flash crash we've seen in human finance. Auction gaming. Research shows agents can collude or misrepresent preferences, undermining fairness. On-chain exposure. If agents gain direct access to crypto wallets and smart contracts, fraud and cyber attacks could scale dramatically. Governance gaps. Who is accountable for an autonomous agent's actions? Without identity and credentialing systems, regulation becomes nearly impossible. For investors, these risks aren't abstract, they're diligence questions. Who controls the guardrails? What's the regulatory exposure? Valuation lenses for investors. When evaluating agent-driven companies, focus on unit economics clarity, transparent cost per task versus ARPU, supplier concentration. Are they dependent on one GPU cloud or one model vendor? Distribution strategy. Are agents embedded into existing platforms, like GitHub, or reliant on a new marketplace? Moats, proprietary datasets, domain alignment, or compliance credentials. Compliance posture. How are they preparing for identity and audit requirements in agent transactions? These are the same lenses venture capitalists once applied to SaaS, but tuned for agent economies. Closing thought. AI agents are no longer just co-pilots. They're becoming economic actors. The trillion-dollar opportunity lies in the clearing layers, the cost curves, and the trust rails. The real investable question isn't whether these economies emerge. It's who gets to run the exchange, who wins on cost per task, and who defines the rules of fairness. Because if agents are going to negotiate, bid, and trade at machine speed, the winners won't just be the fastest coders. They'll be the firms and the investors who understand that in the AI economy, market design is everything. Disclaimer. This video is for educational purpose only. It is not financial advice, and I am not a financial advisor. Please do your own research and consult with a qualified financial advisor before making any investment decisions. If you liked this video, subscribe to this channel and hit the like button. And don't forget to watch other videos on this channel. Thank you.